Hello, everyone. Welcome back to our channel. Today, we'll be addressing some misconceptions presented by the YouTuber Economics Explained in their video about the supposed ongoing hyperinflation in the US. In their video, Economics Explained discusses hyperinflation in the Weimar Republic, Hungary, and Zimbabwe. They suggest that hyperinflation typically follows a destabilizing event, which is then corrected with stimulus measures funded by the printing of money. This, they argue, often results in a failed state. However, this interpretation gets the causality backwards. Hyperinflation occurs when people stop believing that new government debt will be repaid. A failed state precedes the hyperinflation event, not the other way around. People would buy the new government debt if they thought it had value. Mismanagement of monetary policy compounds the original problem. Stimulus measures during an economic downturn, such as emitting new debt during downturns and paying it off during booms, is standard countercyclical policy. This is beneficial as it dampens the business cycle, making downturns shorter and tempering market manias. The central bank, being an independent institution, is more successful at countercyclical policy in a democracy. Monetary policy, which involves adjusting the amount of money in the economy and the interest rate, is dictated by the independent central bank. This institution's primary goal is to keep unemployment low and inflation at around 2%. Economics Explained suggests that market crashes might sting a few investors and push average people's retirements back a few years, but for those with the fortitude to hold onto a broad portfolio, everything ends up fine. This comment overlooks the real issue with a market crash: people might lose their jobs. The video also states that the only way to stop hyperinflation is a massive regime change or total abandonment of a sovereign currency. However, this isn't always the case. For instance, the 1921 Austrian hyperinflation stopped after Austria agreed to make their central bank independent from the government to the League of Nations. Economics Explained mentions that the U.S. central bank printed more than a third of the money supply in 2020, but it might be different than historic cautionary tales. Let's break that down with a graph. The U.S. M2 money supply, a common measure of the amount of money in the economy, saw a significant increase in 2020. According to data from the Federal Reserve, more than a third of the money supply was printed in 2020. This was a response to the economic downturn caused by the COVID-19 pandemic, aiming to stimulate the economy and prevent a deeper recession. However, this increase in the money supply doesn't automatically lead to hyperinflation. Inflation is not just about the amount of money in circulation, but also about the velocity of money, how quickly it changes hands. During the pandemic, with businesses closed and people staying at home, the velocity of money decreased significantly. This helped to offset the potential inflationary impact of the increased money supply. Moreover, the U.S. has strong economic institutions and a high level of trust in its government debt. These factors help to maintain the value of the U.S. dollar, even when the money supply increases. Economics Explained also suggests that because parts of the stock market are up, there's inflation. However, this is a misunderstanding of how stock prices work. Stock prices reflect the expected future flow of profits, not the current value. Therefore, a rise in stock prices doesn't necessarily indicate inflation. It's also important to note that different parts of the economy can experience different inflation rates. For instance, there's a clear speculative bubble in growth stocks and cryptocurrencies. On the other hand, raw materials are at a premium largely because of disruptions in supply chains caused by the pandemic. In conclusion, while it's crucial to keep an eye on inflation and the money supply, it's equally important to understand the complexities of these economic phenomena. Hyperinflation is not a simple consequence of increasing the money supply, and the U.S. is not on the brink of hyperinflation. We hope this video has helped to clarify some misconceptions about hyperinflation. If you enjoyed it, please give it a thumbs up and subscribe to our channel for more economic insights. And remember, economics is not just about numbers, it's about understanding the world around us.